I lost money on PayPal. Starting November 2021, I made a trade on PayPal. I think at the time I was short a 215 strike on PayPal, and PayPal was trading at about 228 the day before earnings, or maybe the day of earnings. And then it missed its earnings announcement, and then it started trading around 202 to 203. And what happened was those 215s were obviously in the money, so I had to roll those positions down. And then thankfully, over the next 2 or 3 months, PayPal essentially traded between 180 and 190 for the majority of that time frame. The problem that I ran into is that usually after a large sell-off, a stock has a tendency to fill in that gap and then retrace some of its prior losses, especially if it's a large cap stock like PayPal, which at the time I think had a market cap of over $300 billion. The problem that I ran into was that PayPal just kept falling. So when PayPal was trading between 180 and 190, I was selling a combination of puts and calls. The puts that I had would have a strike price of about 170 to 175, and the calls that I would sell would be around 210 to 215. What I should have done in hindsight was just sell a large number of call options and use that premium to close out the put options. The issue that I ran into was I felt that PayPal was going to retrace some of its losses and at least stabilize, but it didn't. And then in early February of 2022, when PayPal fell, then I started running into some problems. Thankfully, I did trade relatively small, although prior to the earnings announcement in February, I did actually add some additional contracts on the put side, which was a mistake. But right now, in March 2022, I actually closed out some of the PayPal position, and overall, even though the position wasn't that large, because the magnitude of PayPal's drop was very large, where it fell from trading around $307 to $310 all the way to about $95, where the losses are going to be pretty significant. PayPal is going to end up costing me about 3 to 4 months of trading profits. Now, obviously, it could have been significantly larger if I had traded a lot more contracts, but I do think it's extremely important to not trade too big. What are some of the major takeaways that I experienced? Now, first, let me tell you that I don't believe I've ever experienced an underlying fall 70% in just a few months. Even in March 2020, when the S&P fell about 36% in 33 days, even in March 2020, I don't believe that any of the underlyings that I was trading fell 70% during that time period. And during March 2020, I think that I took losses in Lockheed Martin and RTN at the time, which is now RTX. But during March 2020, I think I suffered some losses in LMT and Raytheon, but it wasn't anywhere close to the amount of loss that PayPal has endured over the last few months. So, what are some of the takeaways that I took from suffering this loss? The first is that I'm thinking of changing my trading strategy to not focus on individual underlyings and instead to focus on indices. The second is that it is imperative to buy options as protection. The third is that I will be a lot more careful when I roll to make sure that I don't expand and add risk to that position. Because similar to PayPal, where I thought that the probability of me being wronged and suffering a loss by adding some additional put contracts onto that trade were really low, the problem with that thinking is that even if the probability is really low, it could still happen. And in the worst case scenario, like what happened with me in PayPal, I did suffer a relatively large loss. Losing 3 to 4 months of profits is not something that makes me very happy. So as a result, I want to make sure that in the future, if I'm going to roll a position, I'm not going to add risk onto that position. Instead, what I should have done, like I mentioned earlier, was it's okay to sell additional call options, but if you're challenged on the put side, then don't add additional put contracts onto that position. Now, in the past, have I added additional put contracts onto a position and not gotten in trouble for it? Yes, 100%. In fact, I think that this is one of the few and only times that I can remember that I've actually gotten caught and gotten in trouble by adding additional put contracts onto a challenged position. But that being said though, but in this situation, it came back to cost me money. So you can make an argument and say, well, in 100 other situations, you increased the risk on this specific trade and you didn't get in trouble. But the reality is that in this specific situation where I had a losing trade, it did come back to bite me in the butt. So basically the main changes are I'm going to consider only trading indices. I'm going to buy put options to protect myself against the tail risk. And I'm going to make sure that I don't add risk to a position. Now, there are some additional changes that I'm going to make. I'm going to trade more short-term durations, and I'm going to add these changes into the course, and I'm going to update the course materials with the latest trading strategy. If you have any questions, leave a comment below. This is David Jaffe with beststockstrategy.com. Please like, comment, share, and subscribe. Leave a comment below and let me know your thoughts and whether you have any questions.